Welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. This is our second look at the biggest brand in monthly dividends, Realty Income. First, my prediction, I still think it's unlikely Realty Income generates market-beating returns from here, but there's a clear case that it could. Let's take a closer look. Realty Income's business is owning standalone properties that it leases to tenants in retail, service, and experiential businesses. It has over 1,500 clients, renting over 15,000 properties, and says 90% of its rents are resilient to economic downturns and not at risk from e-commerce disruption. That's really important considering almost 3/4 of rents are from retail companies. For dividend investors, this stability really matters. It's also why Realty Income has been able to increase its payout at least once every year and often every quarter since the company went public 3 decades ago. Its tenants are primarily large companies that prefer to focus on their core business and work with Realty Income to source and acquire real estate, giving them less debt and more flexibility. Realty Income profits by leveraging its scale, expertise, and access to low-cost capital while taking on the risk of owning and financing properties. When its tenants pay rent, they also pay taxes and are still responsible for property improvements and maintenance. While there is some growth potential in expanding the total footprint of properties out there, a significant portion of Realty Income's growth is tied to continued consolidation of triple net real estate. The freestanding retail market is over $1.5 trillion, total net lease market $4.7 trillion in the U.S. alone. Add in Europe, that's another $8.5 trillion. For context, Realty Income's real estate portfolio is worth about $58 billion. The vast majority of the $13 trillion in potential properties it could own, they're not currently owned by any large public REIT. The growth opportunity is probably bigger than I suggested in our first look at Realty Income, but there are risks to turning that growth into higher FFO per share and dividend growth. To start, Realty Income is faced with refinancing at higher interest rates for much of its current debt. Now, this will happen gradually, but with same-store net rents growing about 1% over the past year and unlikely to be significantly higher than that in coming years, servicing its existing debt will make it harder to grow FFO and the dividend at high rates. There's also execution risk with its expansion into real estate markets it has little history with, including data centers, medical, and industrial, where it faces more competition from experts in those industries. Plenty of winning businesses have lost their way doing exactly this, expanding into related markets where they just weren't as good an operator or acquirer, eroding value and hurting returns trying to build a bigger empire instead of just focusing on building a better bottom line. I love and own Realty Income, but it's more for the high floor aspect than for its upside. At recent prices, the dividend yield is about 5.5%. An average dividend growth rate over the past 5 years is a little over 3%. Over that same period, it's grown FFO per share about 5% a year. With the headwinds of debt refinancing on its bottom line, I think the baseline total return is probably around 10% a year, assuming the valuation remains the same. But there is a case for better market-beating returns. We'll start with the valuation. If it expands a little bit, which could happen if interest rates fall in the years ahead, that could give us better returns. We could also see earnings growth accelerate, but I think the odds are more favorable for solid returns than market-beating returns. All right, let's wrap this up. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insights about Realty Income. Tell us what stock you want to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.